Well, we got a lot to discuss in this week's podcast. First of all, we got the big moves to the downside in global equity markets. We'll talk about what happened here in the U.S. with the stock market. Also, the big moves in the upward direction in the gold market, and finally some weakness in the dollar. Maybe we've had a bottom in gold, particularly as a result of the Fed minutes. We're going to discuss that in great detail and the impact those minutes might have on the perception of future rate hikes and therefore the exchange rate of the dollar and the price of gold. Also, we're going to talk about share buybacks, another way that the stock market has been artificially pumped up. It's not just the Fed at work, but you've got corporations spending too much of their money on stock buybacks and not enough on capital investment. We're going to talk about the continued job-killing effect, not of Obamacare, but also how Obamacare is backfiring, causing companies like Walmart to actually cancel the health insurance that they used to provide to their part-time workers. We're going to talk a lot about some of the ridiculous reporting on CNBC. Just a few examples of some of the real stupid comments I saw regarding the U.S. economy, the euro, the dollar, the housing market, even a bit of a discussion about Bitcoin. Also, we're going to discuss California labor law, not only the efforts in Los Angeles to increase the minimum wage rather substantially, but also how the California is put out of business a small vineyard up in Northern California just because people volunteered their labor. And these are generally retired people who were volunteering for the sheer enjoyment of working on a vineyard, and the government put a stop to it. We've also got our first interview. We always did interviews on the Peter Schiff radio show. Thus far, we haven't done an interview segment on the podcast. Well, we've got one for you on today's show. Our first guest is Peter Thiel, and he's going to be here talking about his brand new book. We're going to talk about technology companies, their valuations, investing. We even talk the Fed, rate hikes. It's a great interview, so sit back. We got a good 2 hours of information coming at you here on the Peter Schiff Show in the new podcast.
You make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
Well, we had quite a week on Wall Street and the markets, and unfortunately, I think you're going to get a lot more downside pressure on the markets until, and I've been saying this for a while, until the Fed caves in, until Janet Yellen cries uncle and gives the markets what the markets need, what they want, which is the QE, the cheap money that they've been addicted to, which has been the source of the rally all along. It's not a strong economy, it's the Fed. And it's the Fed that's created the illusion of a recovery that so many people have mistaken for real. But let's take a look at what happened during the week, because this was the worst week in the stock market in years for the transports. The Dow Transportation Index, that had its biggest decline in over 3 years, down 6.9%. 6.9% down. And that's despite crude oil down 4.6%. That's the worst week in about 9 months. And over the last 2 weeks, crude is down 8.5%. The biggest drop since June of 2012. And the transports are going down anyway. The NASDAQ was down 4.4% on the week, the worst week in 30 months. And the Russell 2000, which is an even broader measure, which has been weaker, was down 4.6% on the week. The Dow is now flat on the year, maybe slightly negative, but the NASDAQ is down, the Russell 2000 down. In fact, the Russell 2000 has the worst chart of them all, and I think it's interesting that the most economically sensitive measures, which would be the transports and the Russell, are the weakest. So everybody's talking about the U.S. recovery, yet the economically sensitive indexes are the weakest. And of course, these deal directly with the domestic economy. You don't have the multinationals in the Russell 2000 that you have in the Dow. And if all this story about how, well, there's weakness overseas, but America is, an island of strength in a sea of recession, if that really were true, why are the indexes that are most tied to the U.S. economy the weakest? Again, look at the housing stocks. That's about the weakest looking sector out there, although this week, the technology sector really got clobbered. So to me, you're seeing a turning point in the market. Again, all this volatility likely indicative of a top in the market and a turning point. And this has been ongoing for months. The stock market has never really been able to make significant progress this year. I've been talking about that all year, even though the major averages have recorded gains up until now. Beneath the surface, the average stock was declining. In fact, there are many stocks that are already in bear markets, and you can't really see it if you're just looking at the headline. And, even though this was the worst week in years for stocks, on Wednesday, the stock market had its biggest gain of the year. Biggest gain of the year. Up 270 points. Yet despite the spectacular rally on Wednesday, the market still finished with its worst loss of the year. Now, for a change, gold actually was up. It was up almost 3%, 2.7% on the week. That's the best week for gold in 6 months. Silver up just under 3%, had its best week in 4 months, and the dollar index was down. This is the first week, I think, in 12 that the dollar index declined. It's the worst week in 6 months. And the losses, could have been, bigger for the dollar and the gains bigger for gold. But the last day, I think we did get a little bit of a rally back in the dollar with the weakness in the stock market, and that also hurt gold. But gold was actually up 4 out of 5 days. Monday through Thursday, the price of gold was up. I can't remember the last time I saw gold up 4 days in a row. And on the 5th day, on Friday, it was only down about maybe $1.50. So it almost made it 5 for 5. And gold stocks, even though gold was up 4 out of 5 days, gold stocks were down 4 out of 5 days. So gold stocks mainly following the stock market down rather than the gold market up. But gold stocks still finished slightly positive on the week. And we'll see what happens next week if the stocks are going to follow the rising price of gold or continue to be held back by the falling price of stocks. I think they're going to decouple. And I think if this gold rally continues, the gold stocks are going to follow and eventually take the lead. But what happened on Wednesday? Why did we have such a big rally on Wednesday despite weakness earlier in the week and later in the week? Well, we got the announcement from the FOMC, Federal Open Market Committee. We got their minutes. And remember, the last time the Fed met and they put out an official statement, I said that the statement was very weak, very dovish. That basically what the Fed was saying is they're not really going to raise rates. It's all data dependent, and they really weren't making any steadfast commitments to raising rates. But then when Janet Yellen gave her press conference, the markets reacted as if she had come out and said, we're about to raise rates, even though she didn't say that. But that was the headline that everybody ran with. So everybody was under the impression, that a rate hike in 2015 was a fait accompli. And the question was, how soon was it going to happen? And that's why all the economic data that's negative, and we've been getting bombarded with negative economic data almost every day that they release it. Yet the markets ignore the negative data and they just latch on to the small pieces of positive data that come out and say, you see, this validates the recovery, the Fed's going to hike, even though they ignore the weak data. And this was no exception. If you look at the data we got this week, on Monday, we got consumer spending numbers, a big drop in consumer spending from August through September. That wasn't expected. And I think probably the weakest number that we had earlier was the consumer credit number that came out. And this number really, if you're looking for the consumer to power the economy, this number was a disaster because they revised down last month from a $26 billion increase in consumer credit to 21.6. But this week, versus an expectation of $20 billion increase, the increase is only $13.5 billion. So consumers are running out of credit. And the only way consumers can spend is if they can borrow, because we know they're not earning the money. Consumers' real wages are declining as people lose full-time jobs and get a part-time job instead, or get no job and are living off of disability or unemployment or food stamps or welfare. It's interesting, that more people are dependent on government programs today, 5 years into the recovery, than before the recovery began. And I don't think there's never been a recovery on record that's created more poverty. Normally, you alleviate poverty. People get off the dole during a recovery, not during the Obama recovery, because the longer we recover, the more people need government assistance. The only credit that's really growing right now, and it's growing, like a weed, straight up, is auto loans and student loans. And the auto loans are growing because pretty much, anybody that can fog a mirror now can buy a new car thanks to government financing and the cheap interest rates. So we've been really channel stuffing in the automobile market. The subprime auto market is exploding, which is another reason why the Fed can't raise rates and pull the rug out from the auto sales. And also, the student loans are off the chart. And you might be thinking, why are so many people borrowing money to go to college when so many college graduates are driving taxi cabs or waiting tables or can't even get jobs waiting tables because, they're unemployed because all the waiter and waitress jobs are occupied. And so they can't even get those jobs. So given the lack of value of a college degree in the market, why are so many people borrowing so much money to get them? And I think the answer is people are not necessarily borrowing money, taking out student loans to finance their education. They're taking out these loans to finance their living, their lifestyle. And not that their lifestyle is that grand, but they're trying to pay their rent. They're trying to pay their electric bills. They're trying to pay their grocery bills. What's happening is a lot of people who have kind of run out of lifelines, they've exhausted their unemployment benefits. What do? They enroll in school. They sign up for an online college. Right? And now they can get student loans. They can borrow $10,000, $20,000 because they're enrolled in some online university. Now, of course, they don't even care about the education that they're supposedly getting. They need the money. And the only way to get the loans is to pretend to be in school. So the beneficiaries of this are obviously these online colleges that get people to sign up that really don't want to sign up. They don't want the so-called education, even if they're going to learn anything, which they're probably not. They're probably just going through the motions. What they really want is the check. They want the money. Now, what about paying it back? That doesn't even enter their mind. They just want money now. They need it. And look, they know now they're saying, look, you only have to pay back your student loans. You only have to pay no more than 10% of your income. And hey, these people don't have any income anyway. So they're not going to have to pay. Plus, you don't have to start paying the loans until you graduate. So who knows how long people can stay in these online programs. Hey, they can get online PhDs. They can be there forever as long as the money keeps rolling. But this is where all the credit is going. And even credit card. Right? Americans are having a harder time using their credit cards, and that is only going to get worse. So despite all the bad news, right, the bad news that we got on Monday and Tuesday, the markets were selling off on bad news because they believe the Fed is out of the ballgame. They believed it until Wednesday. Wednesday was like a big wake-up call when these FOMC minutes were released, because for the first time really in a while, you had some more frank discussion about the worries that the Fed has about the global economy, about the problems in Europe and the problems in Japan. Of course, the economic data on Europe has gotten worse since the Fed met. So if they were concerned then, they're a lot more concerned now. Plus, of course, I think they are much more concerned about the economy than they let on in these minutes. And it's not that they're really worried about a contagion from abroad, right? The U.S. is going to get sick. We're going to catch the world's flu, right? That the weakness in Europe is going to spill over. Our economic problems are homegrown. It's not about Europe's problems coming to America. Our problems are already here. I mean, it's kind of like what I was saying in the mortgage crisis when people said, well, are the subprime problems going to spill over into the general market, mortgage market? And people said, well, no, it's contained. And I was saying it's not contained and it's not about spillover. I said the problems in the subprime are the same problems in the overall mortgage market. You're just seeing them erupt first in subprime because they're the weakest links in the chain. But I said the whole market is infected with what's the symptoms that you're seeing in subprime. So America is sick all by itself. It's not about catching it from Europe or Japan. We've got it. In fact, I think we've got the disease in an even bigger dose, except that we're still medicating it. We still have so much QE and cheap money medicating the disease that you don't see the symptoms yet. Europe didn't do as much QE as we did, and so they're not as numb to the economic pain, even though our pain is our problems are worse. So our pain would be even greater if we were allowed to feel it. But the Fed is publicly worried that the problems in Europe are going to spill over, and in particular, they cited the strength of the dollar and the downward pressure it's putting on commodity prices as a reason for concern. You would think that the Fed would welcome, if it was a normal Fed, they would welcome American consumers getting a little relief at the gas station or at the supermarket. If prices were coming down, that could invigorate the economy because now consumers could spend more. If they spend less on gas, if they spend less money getting their car to the store, they can buy more stuff when they're at the store because it didn't cost as much money to get there, right? And even work. There are probably some people that are turning down jobs because it's not worth the cost of commute. Well, maybe if you bring down the cost of commuting, work becomes more attractive. So there's all sorts of ways that normal people would think that lower costs would benefit the economy. But no, the Fed is worried, right? They're saying we're worried about the pressure on consumer prices. We're worried that we won't meet our inflation objective, that it's going to be below 2% for years. And this is what they're worried about. Now, of course, this, to me, it's nonsense. They're not worried about falling gasoline prices or falling food prices. That's nonsense. But what prices is the Fed worried about? Falling real estate prices, falling stock prices. Those are the prices that have actually been falling. Consumer prices are still rising year to date, but not stock prices. Real estate prices are now coming down also. That's what the Fed is worried about. Why? Because it's a bubble economy. They inflated it. They don't want it to deflate. But the problem is they're threatening to take out the air. What do they expect? That the bubbles are going to stay inflated without the air? No, right? The Fed admitted from day one that QE was all about asset prices. And it was. That's all it did. Now, it didn't spill over. See, they believe in trickle-down monetary policy, right? Remember trickle-down economics, right? The Democrats try to give it a bad name. The whole idea that if you have prosperity, that it trickles down, which it does. If you have businesses making investments, right, capital investments, then you're going to create jobs. You're going to have production, which is going to lower the cost of living. I don't like the way they describe it. It's not about giving money to the rich and hoping they spend it and it trickles down. It's not the spending that trickles down. It's the investment. That's what trickles down, not consumer spending. It's the money that wealthy people don't spend, the money they save that gets invested. And it's the investment. It's the capital investment that grows the economy. Right? That's the point that we try to make so simply in the book, How an Economy Grows and Why It Crashes. And if you haven't read that book, I know somebody wrote an article at the Mises Institute, which got picked up also on Zero Hedge. A lot of people have read it about the original book that mine is based on, How an Economy Grows and Why It Doesn't. And, so we redid that book in How an Economy Grows and Why It Crashes, both the original and the collector's editions. And if you don't have copies, and by the way, I see on Amazon, they're selling copies of my father's original book for $170 a piece. I'm going to see if I've got any more copies. I've got some books in storage. I know I've still got some Kingdom of Maltzes, and I did find a few more copies of The Biggest Con, which we will be selling at some point before the end of the year. Those are great books. In fact, it's The Biggest Con, my father's book about economics, where both How an Economy Grows and Why It Crashes and The Kingdom of Maltz originated. The original text for both was in that book. The Kingdom of Maltz was pulled from the book, so it didn't appear, and my dad released it as a standalone book. Eventually, he did an illustrated version of How an Economy Grows and Why It Doesn't, which is the one that was written about in that article at the Mises Institute, and where my brother and I based our book on, because we loved it as a kid, and so we kind of modernized it and made it a little bit more substantial. Though there's some people that prefer my dad's comic book version of that book. But anyway, let me get back to the discussion. So trickle-down monetary policy. What's trickle-down monetary policy? That's where, well, the Fed says if we goose asset prices, if we make real estate prices go up and stock prices go up, that's going to trickle down as like a wealth effect, because people are going to feel wealthier, they're going to go out and spend more, they're going to borrow more, and that new spending and borrowing is going to fuel the economy. Well, that, right, is voodoo economics, right? George, that's not going to work. That is a bunch of nonsense. You can't create prosperity by raining money on Wall Street, right? And hoping that somehow it trickles into the real economy. The real economy is suffering. The Fed is diverting resources that would grow the real economy, and instead is enriching speculators on Wall Street and creating the illusion of some kind of recovery, even though under the surface, the economy is weak. But when the Wednesday minutes came out, it was like a big wake-up call. All of a sudden, people thought, maybe the Fed's not going to hike. And what happened? We had a huge rally in the stock market, a big reversal. And the biggest reversal was in gold, or the gold stocks. They were up like 7-8% on the day, right? That one up day was big enough to wipe out the losses on the other 4 down days. And we had a big drop in the dollar, because for a moment, people started to entertain the idea that maybe rates aren't going to go up as early as we thought. Now, I believe that more of those type of statements are coming out, and I think the headlines are going to start to turn. People are going to start pushing back when they think the Fed is going to raise rates, and the next step is, instead of talking about higher rates, they're going to be talking about more QE. Because remember, the economy is already slowing down considerably, and QE is still here. All they've done is take their foot off the gas slightly, but it's still on the gas. And we are decelerating rapidly, headed to recession, having nothing to do with what's going on in Europe. But the fact that anybody could be foolish enough to believe that Japan can go into recession, Europe can be in recession, and the Fed can be raising interest rates and maybe shrinking its balance sheet, and somehow an over-leveraged U.S. economy, despite all the problems in the rest of the world, and despite higher interest rates, that we were going to be immune and just keep on growing? I mean, how incredibly naive you would have to be to believe such a fantasy. But maybe it takes, these Fed minutes to get people to see what they should have been able to see all along. So I think the conversation is going to start to switch. I'm not even that sure that when the Fed meets next, that they're going to end a QE. Right now, they're down to doing, I think, $15 billion a month officially of QE. Right, $10 billion in treasuries, I think, and $5 billion in mortgages. Plus, they're reinvesting the principal and interest. Right, they're still doing that. Maybe next time they meet, they are going to use the data to ratchet it back up, because they've always said they're data dependent. Right, and I've always pointed that out. They said they could just as easily increase QE as taper it. And maybe that's what's coming. And if the stock market continues to go down, right, they have no choice. They can't sit there and let the stock market go down. And believe me, the technicals are eroding very rapidly in the stock market. Why do you think oil prices are dropping so much? It's because the market is sensing global recession. Look at the yield on the 10-year Treasury. These are the lows for the year. Collapsing oil prices, falling long-term interest rates. Do these markets think that we're headed for a recovery? Doesn't look like it. Economically sensitive stocks like the transports and the Russell getting clobbered. Does that sound like they're telegraphing a recovery? No, we're getting ready for the next recession. And the Fed is going to figure this out. And the markets are going to figure this out. But listen to this nonsense on this article written in Bloomberg. And I talk about Bloomberg because these guys often have the worst articles, the worst ones. There's so much economic ignorance at Bloomberg. I mean, they're off the charts. They're worse than the Wall Street Journal. That's why they probably banned me from their airwaves 5 or 6 years ago. Although they still have guys like Mark Faber on, but not me, you know. But and it maybe, you know, for him, it's, you know, he's a little bit more. I think his delivery is a little bit different than mine, and I'm not really sure what the big difference is, you know, or why they have Faber on, because he talks about all the problems, but they didn't have him on nearly as often as they used to have me on, you know, before my predictions came true. But anyway, the articles in Bloomberg are horrible. I mean, they express an incredible degree of ignorance when it comes to economics. And this article from this week by this guy Craig Torres, right, is certainly no exception. Here's the headline: Fed aim off target as inflation descends near danger zone. So inflation is going towards the danger zone, the economic danger zone. And what is the danger zone? Below 2%. It's going down. It's a danger zone. Why is that dangerous? All right. I'm going to read a little bit of this article. All right, here. Federal Reserve officials are hunting for new tactics to raise price increases to their target as slowing global growth, cheaper commodities, and flat wages sound warnings that inflation is descending towards the danger zone. Right? The danger zone. What's so dangerous about low inflation? Here, the Fed needs a clear strategy for getting inflation higher after falling short of its 2% target for 28 consecutive months. Well, so for 28 consecutive months, we've had inflation. It just has been lower than 2%. It hasn't been much lower. It's been in the ones. I mean, so 2% is great, but 1.5% is the danger zone. We better be careful. And as if the Fed can just simply, you know, fine tune the inflation rate, just turn it up like a thermometer, a couple of notches. Here, listen to this. Now, as longer run inflation expectations erode, the Federal Open Market Committee is shifting its focus towards prices after putting its main emphasis on jobs. This is one thing they probably got right about their read of the Fed. Several officials worried that inflation might persist below the committee's target for quite some time. This is referring to the meeting minutes. And here I think they're right, because I think what Janet Yellen and what she said, or what the Fed revealed in these minutes, is that considerable period of time is making the Fed nervous, because they don't want people to think it's a measure of time, like months, right? They want to be data dependent. They want to say we're going to raise rates not just after a considerable period, but we want to raise rates when the data suggests that they should be raised. Now, the Fed initially thought that would probably take a considerable period of time before the data would be good enough to raise rates, but they want to take the focus off the considerable period, which they never defined, and just tell people, look, it's the data, because they can always hide behind the data. They're going to massage the data any way they want, and they're going to find an excuse not to raise interest rates. Before, the excuse was, well, unemployment was too high. We're going to raise rates when unemployment is 6.5%. Well, now it's 5.9%. So now what's the excuse? Well, now the excuse is inflation is too low, right? They're going to make one excuse after another, which is what I've been saying all along, because they can't raise interest rates. But the one thing they can't do is admit that. So they have to pretend that they're going to raise rates in the future, but not actually raise them now. And they can't commit to a particular time when they're going to raise rates because, A, they're not going to do it, but B, they don't want the markets doing what they're doing now, which is starting to anticipate a rate hike. See, markets are forward looking. They start to think about the future. So if they think the Fed's going to raise rates, they don't wait for the rate hikes. They start pricing it in now. And that's what's happening in the stock market, which is what's scaring the hell out of the Fed. Here's more from this article. Too low inflation is getting to be a real issue, said former Governor Lawrence Meyer, with inflation at 1.5%, according to the Fed. So 1.5%. I mean, that's almost 2%. I mean, if you round 1.5 up to 2, right? If you're going to round it to the nearest whole number, 1.5 rounds up to 2, doesn't round down to 1, right? And I'm sure it's 1.5 something. So you're practically there. If you want 2% inflation and you get 1.5%, you should be happy. I mean, you're pretty much there, right? But with a 1.5%, according to FOMC preferred index, Meyer said FOMC policy makers aren't likely to raise interest rates, even if the economy approaches full employment, as defined at a rate of 5.2 to 5.5. So as long as inflation, the way the government measures it, is 1.5, they don't care how low unemployment is. Here, the timing of the first rate hike is all about inflation, said Meyer, right? So now it's not about unemployment. It's all about inflation. And we know the CPI isn't measuring inflation. Who knows what that thing is measuring? It's certainly not measuring the cost of living. And considering how long the CPI has been below 2%, and if you actually look at what some of these other Fed governors are talking about, they're talking about symmetry, right? A symmetrical inflation, meaning that inflation has been below 2% for a long time. It's been 1%, 1.5%. And so they said that it's okay if we overshoot above 2% for a while, just so long as the average is 2%. So what the Fed is saying is they tolerate 2.5% inflation. They tolerate 3% inflation because it all comes out in the wash. It's all an average. Plus, if we get above 2%, the Fed is going to say, well, we don't know that it's going to stay there. It could be temporary, transitory. We got to give the market time to make sure we're out of the danger zone. We can't take a chance. So basically what they're really saying is if you're going to base your next rate hike on inflation, and it's all based on what the CPI says, and you're willing to tolerate inflation above 2% by maybe 1% or more because, you're looking at symmetry, what is the Fed saying? They're saying it doesn't matter what happens. We are never raising rates. That's what they're saying. I've been saying that all along. Why can the Fed not raise rates? Because they can't. Because the minute you raise rates, there goes your recovery. And when your recovery goes away and you're in a recession, what do? You cut rates. So they can't, right? They're boxed in. It's a catch-22. It's a Roach Motel. Here, listen to more of this article. Policymakers, including regional Fed President William Dudley of New York and Chicago, have in recent days all mentioned below inflation targets as a risk that weighs against raising interest rates. Now, here's where it really gets crazy. The vicious cycle. Vicious cycle. This is what Bloomberg believes the Fed is worried about. Here, an inflation rate approaching zero. Approaching zero. Now, how close? We're at 1.5%. Is that approaching zero? I mean, we're closer to 2% than zero. I mean, zero is a long way away compared to 2. So why are they worried about zero? But here, an inflation rate approaching zero. I guess 1.5% is approaching zero. It's not approaching 2 for some reason, but it's approaching zero. An inflation rate approaching zero is bad for the economy because of its impact on behavior by businesses and consumers. Companies' inability to raise prices hurts profits, and they rarely compensate by cutting wages, so they fire workers. Consumers anticipating falling prices may postpone discretionary purchases. This can combine to create a vicious cycle of less spending and further downward pressure on prices. Complete and utter nonsense. It doesn't happen. First of all, on businesses. If businesses' costs are falling along with their prices, their profits are not falling. And if their prices go down, their consumers, their customers can buy more stuff, right? The lower the price, the more you can buy. So businesses actually make more money when prices fall, which includes their costs, and now they can sell more stuff because their products are more affordable. Why is it that businesses are always trying to lower their prices, right? Aren't business owners always trying to find ways to cut costs so they can pass on their lower costs to the consumer and lower prices? They're always competing. They're trying to gain a market share. They're trying to reduce their prices. When they have a price cut, they advertise it. When a businessman lowers prices, they advertise it. It's a sale. When they have to raise prices, they want to hide the price increases. They don't want the consumers to know that they're raising prices. That's why you've got all this, supposed shrinkflation, where they try to just cut down the packaging size. If raising prices were so good, if higher prices motivated spending, then companies would be bragging about their price increases. They wouldn't want to hide it. And if they were reducing prices, they wouldn't want anybody to know. Nobody would advertise a sale. If falling prices were going to be so detrimental to consumer behavior, then why would they advertise sales? This is nonsense. I just talked last week in the blog about the Chinese paying $3,000 for iPhone 6s when they can just wait a month or two and buy them for $300. Is the prospect of a 90% reduction in prices in just a couple of months, is that stopping the Chinese from buying these phones? No, they don't care. They want them now. Now, the only people who aren't paying the $3,000 who are waiting are the people that don't have the money, right? They're waiting for the lower prices, not because they're waiting because they can't afford it. They can't afford the high price. It's not that they're just postponing it. Because the people who are paying $3,000, they could wait and pay $300. Why not? Because they don't care. They want to have it now. And if people are not willing to postpone buying something they want to buy, even though they know the price will be 90% lower in a couple of months, then why on earth would consumers not buy stuff just because they think it'll be cheaper a year from now? And proof positive that this is a bunch of BS is the credit card industry. Why do people buy things using credit cards, and why do they agree to pay interest? 12%, 18%. Why don't Americans, instead of buying something on a credit card, right? Let's say something is $1,000 and you don't have the $1,000, but you want the product. If you're going to buy it on a credit card and make payments, right, over the course of, let's say, 2 years, you might end up paying it off. But let's say during those 2 years, you end up paying with interest. It doesn't cost you $1,000. It costs you $1,250. So you end up paying $250 more because of all the interest charges on the credit card. Why don't consumers, instead of spending $1,250, why don't they just save their money and then buy the product in a year or two and save the 25%? Because they don't want to wait. They want to buy it now. Consumers want stuff now, and they're willing to pay 12, 15, 25, 30% more. Some people making their minimum payments on their credit cards, who knows how much more they're paying. The nonsense that Americans are going to not buy something that they want because they think, well, you know, if I just wait a year, I can get it 1% cheaper. When they're paying for it on their credit cards and they're overpaying by 10, 20, 30% because they got to have it right now. This is sheer unadulterated nonsense. There isn't a shred of economic evidence or common sense that would support this nonsense argument. Yet every economist parrots it like it's the gospel. I mean, all these articles that you read, and nobody questions it. They just accept it. Just accept it as if it's some kind of truth. This is complete nonsense. Here, look at our article here. Prices fell 1.2% for the 12 months ending in July 2009, right? When the economy had just exited recession. So the one time we got prices going down was July of 2009, year over year, 1.2%. Big deal. Big deal. And so they're saying, oh, we can't let that happen again, or we'll be back to July 2009. Look, everything was falling. Everything was collapsing in price. And the most we got out of the CPI was minus 1.2 briefly. And of course, you know, the actual prices, I'm sure, were going up. But this is what everybody is saying. And if everybody believes that inflation below 2% as measured by the CPI, or maybe even below 2.5 or 3, if everybody believes that that's a disaster, then what does it tell you about the Fed, right? That they're not going to raise rates, and that the only thing that's coming is another round of quantitative easing. But the idea that falling consumer prices represents such a grave threat to the economy because of the psychological impact on businesses and consumers who are going to refuse to spend, and companies who are going to fire their workers because they can't raise their prices. It's so ludicrous that it's impossible that I think that the Fed actually believes this. I mean, I have a hard time believing that they don't understand what the real threat is, but they're looking for some kind of excuse as to why they feel inflation is necessary and why it's a good thing, because they can't come out and say the truth. So they have to come up with a lie, no matter how ridiculous it is, but they know that these incompetent journalists and economists are going to buy it, and they're going to run with it, and they're going to spread the propaganda and help do the Fed's job. But what they're really concerned about are two things. One, falling asset prices. But the Fed can't really say we have to keep printing money because we want to prop up the stock market. How can they say that? So they have to pretend that they have another reason and that the rising stock market is maybe just collateral damage. Like, well, we're not trying to enrich the 1%, but it's happening anyway because our real focus is on inflation at the consumer level. But meanwhile, what the consumer would really benefit from is lower prices. But imagine if the Fed said, we need high stock prices, and so we're willing to make food more expensive and gasoline more expensive. We're willing to make the cost of living go up for the average American because we want to enrich the speculators and the 1%. How well would that fly with the public at the polls? So they can't say that. They can't say they're targeting assets, and the rest of us, the average guys, have to endure higher consumer prices so that the rich can enjoy higher asset prices. They can't put it that way. So what they have to say is, we can't allow consumer prices to go down because that's a bad thing. And so we need inflation to make sure that that bad thing doesn't happen because it's going to hurt the economy. As big a nonsense as that is, that's what they say. And the other reason, and maybe even a more important reason why they can't let interest rates go up, other than inflating asset bubbles, is because we just flat out can't afford it. The only reason that the national debt is manageable, other than the fact that our foolish creditors keep rolling over the maturing principal, and that the Fed is doing QE, but it's that interest rates are so low that the government can borrow at practically nothing. What would happen if interest rates rose? Well, we'd be just as broke as Italy or Greece. You know, these countries had no problems paying their enormous debt until interest rates went up. Then suddenly they had a problem. Well, they didn't suddenly had a problem. They had a problem the whole time. It's just that nobody recognized it because the interest rates were still low. You know, it's like you can be sick, right, with the Ebola virus, but you don't know about it until you got a very, very high fever, until you can measure it somehow. But there's a 21-day or something incubation period. So you could be sick with Ebola for a long time before anybody knows about it. And so the same thing is going on now. You know, you don't know about how sick the economy is until the interest rates go up, until the temperature go up. But once interest rates rise, that's when people start to question the ability of governments to pay their debt. But they should question it before interest rates rise. But because they're not rising, nobody is questioning anything. But the minute rates go up, it's a whole new ballgame. Because now people start to do the math. Wait a minute, the government can't afford to pay these rates. And as rates go up, the deficits themselves go up because now more money has to be borrowed to pay the escalating interest costs on the debt you already have. So it starts to snowball. So the Fed has to keep that at bay as long as possible. It has to keep all that swept under the rug. So it needs to keep interest rates at zero, and it needs the inflation itself to wipe out the value of that debt. You see, when there's no inflation to wipe out your debt, you got to pay it. We can't pay it. All we can do is repudiate it. We don't have the ability to do that. I mean, we can't repay the debt because we can't raise taxes on a shrinking tax base. And the government doesn't have the guts to default. So all they can do is inflate. And when they're worried about a strong dollar, it's not because they're worried that the strong dollar means that Americans can buy more stuff cheaper. It means that it's going to be more expensive to repay the debt because all of our debt is in dollars. We've borrowed trillions of dollars. We can't pay them back if those dollars are more valuable. We need the dollar. The government needs the dollar to lose value so that it's easier in real terms to repay the money it's borrowed, or actually not repay, but to default. It's to not repay. That's why the government wants a weak dollar, because it's a declining purchasing power. It's a way out. It's their get out of jail free card from their perspective to how they're going to repudiate their debts without actually officially doing it. That's what it's all about. But again, how is all this going to play out? What is the end game? The end game is that we're going to get another round of QE, whether it's QE4 or just QE3 redo. And again, combined with some kind of big pump priming stimulus, that is what is coming. And it is going to be a game changer, a wake-up call for these markets, particularly the foreign exchange markets and the precious metals markets. Commodity markets will respond, will turn on a dime once the dynamic changes, the conversation changes, and people realize what's actually going to happen when they pull their heads out of the sand and stop living in this economic fantasy zone and start to accept and understand the reality of the situation.
The Peter Schiff Show.
You know, usually during the week, I got CNBC on, and you know, and sometimes I'm on Fox Business too. But I'm trying to follow the markets mainly to kind of see what other people are saying. And the stuff that's said, I mean, it never ceases to amaze me how foolish the comments are that come out of so many people's mouths, whether they're the hosts on the show, you know, the anchors or the guests that come on. And this week, of course, lots of dumb things were said because we had a lot of, you know, weakness in the stock market, strength in the dollar. And so there were a lot of comments and a few of them that I happened to catch. Now, of course, I'm sure there were even dumber things said that I didn't hear because I don't listen to it constantly. I tune in and out. You know, I got a lot of other stuff that I'm doing throughout the course of the day. So maybe I managed to catch a half hour of it a day. And the fact that I still managed to hear so much stupid stuff just shows you how much is actually being said that I don't even know about, right? But one in particular, Simon Hobbs, is one of the anchors. I've been on with Simon, you know. In any event, so he's talking. I forget who he's talking to. But he's trying to talk about how strong the U.S. economy is.
We were trying to work out why suddenly the market would, A, get this volatile and yesterday moved down to the degree that it did. And one argument is that a lot of investors in this country were focused on the great growth that we have here in 10 years over the last few quarters.
The fastest growth in 10 years. What is this guy talking about? In the first half of the year, the GDP grew by 1.25%. How is that the fastest growth in 10 years? Even if you average in the quarter before that, you're still not the fastest in 10 years. In fact, 2014 is on pace to have less economic growth than 2013, which had less economic growth than 2012. So what are you talking about? The only thing you can be talking about when you're talking about fast growth is the second quarter, where we got 4.6. But that's not real. I mean, so is Simon Hobbs really going to say that the U.S. economy is so strong because the second quarter was so strong? Well, when the first quarter was so weak, was he saying, well, the U.S. economy is really weak because it's contracting so much in the first quarter? No, they blamed the first quarter weakness on the weather. Well, that's the only reason the second quarter was so strong, was because all the activity that didn't happen in the first quarter happened in the second. Average them together, you get 1.25. That ain't strong. And again, the other reason that Q2 was so strong was the big inventory build. And what's going to happen to all those inventories when the companies realize that demand isn't there, that they anticipated a recovery that ain't going to happen? They stocked up on goods, and now they can't sell them because the customers don't have any money, because they believed in this myth of a recovery, and then when the reality showed up, it wasn't there. In fact, all these commentators I hear talking about Christmas are talking about how this is going to be the best Christmas season in years. You know, from what I'm looking at, it could be the worst Christmas in years, not the best Christmas in years. So I think a lot of people who have been holding on to their workers because they've been anticipating a recovery are going to be sending out a lot of pink slips for Christmas, or maybe they'll hold off until January. In addition, they're not going to be building up any more inventories. They're going to be trying to liquidate what they got, which means they're going to buy less, and all of that is going to diminish future GDP. But I couldn't believe this. The strongest economy in 10 years. This is the kind of nonsense that is out there. Now, here's another guy talking about the bull market in stocks. And again, a lot of guys are coming on CNBC this week to tout the market because the market's going down, and so they need the talking heads to reassure everybody how great everything is. And, you know, I point out a lot that we're overdue for a recession, that it's been 5.5 years since the recovery supposedly began, and we're due for a recession. And this guy is trying to argue that the next recession is years away.
If you look historically, bull runs continue until you get your next recession. And because this is such a weak recovery, I don't think this is a 7-year business cycle. I think this is a 9, 10, 11-year business cycle.
How old is it now?
5.5, which means I think we're talking about a 12 to 15% per year kind of return for the next 3 or 4 years on this.
He says that a normal business cycle is about 7 years, and it's actually shorter than that. So he's a little off. It's not as long as he thinks. But he claims that this cycle is going to last 9, 10, or 11 years. And see, he says that, well, you don't have to sell the stock market until the recovery is over and the recession begins. And so he says, don't worry, because we got maybe, another 5 or 6 years left of this recovery. So we've got another 5 or 6 years where the stock market's going to go up 12 to 15%. Now, how is he coming to this crazy conclusion, right? I mean, what's the basis? Well, I mean, if you listen to what he says that because this recovery is so weak, which it is, it's the weakest recovery ever. He said because it's so weak, that's why it's going to last so long. I mean, come again? I mean, how does that figure? I mean, it doesn't follow logically. Because this is the weakest recovery, it should be the longest. The weakness is going to give it endurance. I mean, if anything, you would say the recovery is so weak, it's amazing it's lasted this long. The fact that it's so weak must show you, right, that there's a big problem here. Why is it so weak? The weakness doesn't give it longevity, right? It just shows you how vulnerable the recovery is because it's been so weak and how vulnerable we are as an economy to the next downturn. But it's such wishful thinking to somehow infer out of the weakness of the recovery that because it's so weak, it's going to last so long. It's going to be twice as long as a typical recovery because it's so much weaker. And because it's so much weaker, the stock market's going to go up for twice as many years, as if a weak recovery is somehow better than a robust one. But again, this is the type of irrationality that you get, the type of just mindless cheerleading. No matter what the news is, it's bullish for the stock market. So the dumbest things I usually hear are not about the stock market. I mean, it's usually about inflation or the currency market. And certainly this week, a lot of talk about the currency markets with the strength of the dollar. So again, here's Simon Hobbs talking to Art Hogan. And Simon is bringing up, I guess, some guy from Bank of New York Mellon mentioned that for the first time in decades, the U.S. is losing the currency war.
The oldest bank in this country, BNY Mellon, is suggesting that for the first time in decades, the United States is losing the currency wars, and clearly the dollar is a lot stronger.
And by losing, he means winning, right? Because you lose a currency war when your currency goes up. So the dollar is going up, and somehow now, this strong dollar is bad news for us, right? The weak dollar was good news. Then Art Hogan basically saying, yeah, that's absolutely happening.
You need to have that happen. You need to have Europe become more competitive in a global marketplace so that, when we see the euro dollar cross get down to the levels we've seen, and there's plenty more room to go. We would offer up that probably 116, by the end of 16 is the level you want to look at. Makes them more competitive, increases their, ability to export and stimulates their economy.
Well, does Art Hogan not realize this? But Europe has a trade surplus. And specifically, Europe has a trade surplus with America. So we have a deficit, they have a surplus. How is it that Europe is the one that's not competitive? Wouldn't it be America? If we have a deficit, we're the country that's not competing. They already have a surplus. I mean, I can see if the country had a big trade deficit and you're saying, look, you need to be more competitive. You need to clear your trade deficit, but they have a surplus. It's America that lacks competitiveness, not Europe. Now, does that mean that Europe couldn't be more competitive? Of course it could, but it's already more competitive than America. So if you're looking at global competitiveness, it's the dollar that should be falling, not the euro. Now, there are things that are undermining the European economy, but none of it has to do with the strength or weakness of their currency. It has to do with their labor laws and their taxes and their regulations. But none of that is going to change. In fact, here's another example from CNBC.
For the last 15 years, the fact is the euro has risen 35% against the dollar, and that's been a huge advantage for us. Maybe it's now that we pass the baton to Europe, let them ease their currency, and this is really our premise, and allow them to grow.
But you don't benefit when your currency is weak. You suffer when your currency is weak, right? You benefit when your currency is strong because now you can buy more stuff. Right? They all look at it from the point of view of exports and imports. But the goal of your exports is to import. And so if you have a strong currency, you don't have to sell as much to pay for your imports, which means you don't have to work as hard to get the things that you want. So a strong currency means you work less and enjoy a higher standard of living. A weak currency means you work more and you have a lower standard of living. All these, people who, are looking for growth by debasing their currencies. The IMF was out this week and they downgraded all their forecasts for the global economy. They downgraded Europe and Japan, but they upped their growth estimates for the U.S. economy. Now, what does the IMF actually think is going to happen? How is the world going to grow their economy in this situation where everybody debases their currency and sells more stuff to Americans, which we can't afford? And we pay for it by borrowing the money from the nations who are selling it to us. And now the people in those nations don't get to consume the products that they otherwise would have consumed. And Americans get to consume stuff that we otherwise couldn't have had. Meanwhile, consumer goods are diverted from the nations that produce them to America that doesn't produce them. How does that benefit the global economy? And how much more can the world vendor finance us? I mean, is this really the key to the world's prosperity? Find a way to divert your production to America so that Americans can consume instead of your own people? I mean, this whole thing is foolish to believe that that's how an economy grows. But that's what people are trying to get, this advantage of, I'm going to weaken my currency so I can sell more stuff and earn less for doing it. So I sell more stuff, but I can afford to buy fewer imports. So my own citizens end up with less and paying more. And none of that is positive. Also, it's really starting to be deja vu when it comes to the housing market. Very reminiscent of 2007, when I was going on CNBC talking to all these realtors. They don't really have me on anymore. I haven't, been in a debate with a realtor in a long time. But, you go back into the archives and I was debating all sorts of people from the real estate market in 2006 and 2007. And they're starting to bring these guys back on. They're just not putting them on with me. But, I was reading this article during the week about the incentives that builders are now having to include in their new houses, right? Meaning that they got to throw in from freebies. So you buy a new home and it'll come with a swimming pool, or they'll give you the upgraded bathrooms or, cabinetry or better floors or stuff like that. And they throw this stuff in for free. This is exactly what they were doing during the last real estate bubble. And this was a precursor to lower prices. In fact, some developers were throwing in free cars. You buy this house and it comes with a Mercedes already in the garage. Why were they doing this stuff? Because they wanted to give people stuff in order to get them to buy the house without reducing the price. Because they didn't want to create the impression that the prices were coming down, because that would be bad for sales. Because, some other people, you want the impression that prices are rising because people wanted to buy into a rising market. But at some point, you can't just throw in freebies. You got to actually reduce prices instead. And so throwing in stuff for free, that's what happens first. And then price cuts happen second. And so CNBC brings on this realtor, and they talked about this stuff, right? They talked about this article about the incentives and all this. And, are you worried? Are you worried about a triple dip in housing?
I would not be surprised to see some price drops in certain pockets. For example, we've got pockets in Texas right now where, because of the great job market there and because of such slow construction, prices are really going through the roof, and unsustainably so. I also wouldn't be surprised to see it maybe in pockets in California where we've got particularly Chinese buyers running prices up through the roof for a safe haven, even if they're going to lose a little bit of money. But for the nation as a whole, it's just not going to happen because our fundamentals just aren't out of whack with prices. And in fact, in most of the markets, we're still 3 to 5% under where valuations really should be.
I mean, the same kind of head in the sand denial in spite of a mountain of evidence that would show that there was a huge problem brewing in the housing market. Forget about the home builder stocks, which we talked about how weak they are, and they continue to be weak. But the Fed threatening to raise interest rates, to get out of the market for buying mortgages, and all of these speculators, hedge funds, private equity guys, they are going to be unloading their houses. You have a record number of homes that are owned by speculators. And just like people are starting to dump their stock market, their stocks, now that the market is turning, and people want to get out of their stocks, these investors are going to get out of these houses. They didn't buy them for the long term. I mean, they're not living in these houses. They're not paying off a 30-year mortgage. They bought it all cash. They bought it to make a profit. In many cases, they bought it to rent out. And rents now, by the way, now we've got indication that rents are now starting to come down. And so you've got a lot of these vacant homes that people bought. And on paper, while they think they have a profit, there's nothing that's going to stop them from listing these houses for sale. Now that, the momentum is gone and asset prices are rising. But think about it. The economy is weakening. The Fed is tightening in theory. The global economy is in recession. Asset prices are falling. Why hold on to a bunch of homes that you can't rent out? Sell. You don't have a mortgage. Just sell. So you've got, all these negative fundamentals lining up. And one of the things that this woman says, it's kind of amazing. She says, well,
certainly if wages don't continue to increase, we may see price appreciation in homes coming to a grinding halt. But right now, there's a huge difference between the slowdown in appreciation and something that we could ever potentially see calling a drop.
What do you mean continues? There is no wage growth. That's part of the problem. Wages have been stagnant. In fact, real wages are falling. That's why average Americans aren't buying homes. They're stuck renting. That's why home ownership is the lowest it's been in a generation. It's been speculators who have been driving up the price of houses, and it's not based on wages. It's based on cheap money and the momentum and their own foolishness. It's a bubble. And so when that bursts, even if wages go up for a change, it's not going to matter because they're not going to go up enough to make homes affordable given the inflated prices, and especially when interest rates go up. Now, of course, the dumb comments weren't just reserved to stocks, real estate, and the dollar. Also, we had a dumb comment related to Bitcoin. And, I talked about the big drop in the price of Bitcoin last week. We had a pretty nice bounce this week. And so Bitcoin's got back up, I think all the way back up to 370 or 380. I forget. I think I'm recording it now. They're back down in the 350s. I mean, the trend is obviously down right now. There's a lot of overhead resistance in the Bitcoin market. You had this guy that had this order on over the last weekend on Bitstamp. He had this order to sell 30,000 Bitcoins at 300. They've been calling this guy the bear whale. And I know it kind of was like seen as a victory. I think a lot of people in the Bitcoin community went in and bought a lot of these Bitcoins that were for sale at 300. And ultimately, they filled him, or I think maybe he canceled part of the order. He got rid of most of his Bitcoin. And I think people symbolically think that was some kind of low. And that, they banded together. They took this guy out. They stopped the decline. And now the market's going back up. I don't think so. I think we're going back down there. And I don't know if the same sellers got more behind it. I mean, I doubt that he cleaned himself out. I don't think those were his last 30,000 Bitcoins. I think whoever sold them probably has more. And I don't think we've seen the last of that bear whale. And maybe there's more coming. But the next time, people might not be so quick to take those offers. But I think we're going back down. But they had Marc Andreesen, and I think he's the guy that bought all those Bitcoins at auction from the federal government. And I don't know what price he paid. I mean, I think I know at the time of the auction, Bitcoins were probably around $600, maybe $700 a coin. Now, I don't know what the winning bid was at the auction, so I don't know what he paid, but I'm sure it was a lot higher than the current price. And so he's talking about Bitcoin. He's got these other Bitcoin investments. And so he's asked, about the price going down. Are you bothered by that? Is that a problem? And he basically says, oh, it's irrelevant. It's immaterial.
The price is gonna go all over the place. Like there's not the price is gonna go all over the place. We're not really focused on the price. We're focused on the technology that's getting built and the infrastructure that's getting built. I mean, Bitcoin is a global payment network.
Is this guy for real? Does he really believe this? I mean, it's only a payment network if people want the Bitcoin. And what attracted so many people to Bitcoin was the price increase. It was the fact that they went from practically zero to $1,000 of Bitcoin. What made Bitcoin so valuable as a payment system was the wealth that so many people had tied up in Bitcoin, because now you had all these potential customers who had all this money in Bitcoin, all this supposed purchasing power. And it was the fact that more people were going to want to adopt Bitcoin because they were going to want to get rich too. But when Bitcoin goes down from 1,000 to 300, Bitcoin purchasing power goes down. So the Bitcoin owners are not as attractive anymore to potential merchants because they don't have as much buying power, right? Because their Bitcoins aren't worth as much. But it also makes Bitcoins less attractive to a potential new adopter, because now instead of visions of wealth, as he thinks that Bitcoins are just going to appreciate forever, all of a sudden he says, wait a minute, why should I buy this Bitcoin? It was 1,000, now it's 300. What if it goes to 30? I don't know that I want to buy. I don't want to take all that risk. So the price going down undermines the credibility, the desirability of owning the Bitcoin in the first place. And if you don't want the Bitcoin, what do you need the payment network? The payment network only has value to the extent that the Bitcoin has value. If Bitcoins don't have any value, what difference does it make how easy it is to pay with it if you don't have anything to spend because you have no purchasing power? So it seems, I mean, maybe he genuinely believes this, and maybe there are plenty of other, Bitcoin enthusiasts that have got their head in the sand on this as well, and they think that the price is immaterial. The price is very, very important. The appeal and the rewards. Remember, if you adopted early, you were promised a windfall. Get in now before everybody else. You buy your Bitcoins at 1,000 because eventually they'll be 10,000, 100,000. You just get in early, right? Well, when your Bitcoins go down, and if they keep going down, I mean, if he thinks that Bitcoins can crack 100 and it's not going to undermine the value, I mean, I think a lot of these Bitcoin startups that are being funded are just going to collapse. When the price of Bitcoin collapses, all these things implode. The payment system doesn't have any value if nobody wants the Bitcoin. It's not like Bitcoin can go to $1 a coin and all these investments are now worth. Because then, meanwhile, look at the market cap of Bitcoin, right? When the market cap collapses, there's not much purchasing power to transfer. So even if it's easy to do it, you can't transfer much in the way of purchasing power because the Bitcoins themselves don't have much purchasing power. So price is very, very important. Yet you have people that are just digging their, burying their heads in the sand. They don't want to admit reality.
The Peter Schiff Show.
I talk a lot about how the stock market is being propped up by cheap money. Right? The fact that interest rates are so low, that corporations can borrow money so inexpensively is helping to prop up the stock market. And of course, low interest rates by definition mean that stocks are more valuable. In fact, whenever you hear the experts talking about stock market valuations, they always compare it to the yield on the treasury. You compare the yield in the stock market to, the risk-free yield and determine a fair value. And so one of the reasons that people think that the stock market is fairly valued is because they contrast it to the bond yields. But of course, that overlooks the fact that interest rates are being artificially suppressed by the government. And what happens if interest rates or when interest rates go up? Well, obviously, then stock market has to come down, all else being equal. So you can't really say that stocks are not expensive simply by comparing them to another asset, bonds, which are artificially expensive. Because eventually bonds have to come back to earth. And when they do, then the stock market has to come down. So it means that there's a lot of risk in the stock market because the valuation is based on the unsustainable level of interest rates. But there's another factor at work here, and that is the amount of money that companies are devoting to share buybacks. Because share buybacks are actually increasing the demand for shares. They're reducing the supply of shares on the market because companies buy these shares and they're no longer available. And of course, when you reduce the number of shares outstanding, you make your earnings per share go up because you have the same amount of earnings, but you have fewer shares outstanding to distribute your earnings. So it makes companies look like their earnings per share are growing when what's really happening is the number of shares is shrinking and maybe the earnings are staying the same or maybe even coming down, but the earnings per share growth is there. Now, of course, any money that companies spend on share buybacks, they don't have to spend on capital investment or things like that. Now, there's two ways that companies can return money, profits to shareholders. The more traditional way is by paying a dividend. But for tax reasons, although not so much recently, because now the dividend rate and the capital gains rate are the same. But for a while, that wasn't the case. But investors had a preference for capital gains over dividends. But now that preference isn't as strong. However, I think a lot of the managers, people that are running these companies, publicly traded companies who have stock options and who are compensated with stock options, they certainly prefer a rising stock price to a dividend, because generally your stock-based compensation is not tied to dividends, it's tied to stock price. And so if you can take action to return shareholder value in the form of rising stock prices, then you can also cash in your options. But the problem is a dividend check is permanent. If a company shares its income with its owners by sending them a dividend check, they put that money in their pocket. They keep that. But if instead they use their profits to buy back stock and the price of the stock goes up, unless you sell your shares, it doesn't necessarily benefit you, because ultimately the share price could collapse and you've got nothing to show for it. At least if you've got dividends, you've got that. I mean, that's like if, taking money off the table. So even if you lose, you've got your winnings in your pocket. But when you're just getting paid through stock buybacks, all your money's at risk all the time. But, those are the two ways. So companies can return money to shareholders by sending them a check or by buying back stock so that the stock that they own is more valuable. So if they do sell it, they'll get more in the way of proceeds, or at least they'll be happy to see the value of their stock in their statement going up. But normally, companies would maybe pay 50% of their earnings back to their shareholders. If it was all in dividends, we would, you call that a payout ratio. What's the dividend payout ratio? If a company had a 40% payout ratio, that meant that they paid out 40% of their earnings in dividends and the other money was retained, right? And what does a company do with its retained earnings? It uses it to make investments. First of all, you've got to make up for the fact that your fixed investments are depreciating over time. Just because you buy some equipment, that equipment doesn't last forever. It wears out and it needs to be replaced. And so you need to make new investments to replace the depreciating investments that you've already made. But you also need to modernize. You need to invest for growth in new plant and equipment. And all of this growth is financed by retained earnings. And it's the retention of earnings that makes possible the long-term growth of the company. If you don't make these investments, eventually your income streams are going to wither away, right? You're not going to be competitive. Your technology, your equipment is going to be obsolete, right? It's going to be archaic. You're not going to be competitive. Now, what have American companies been doing recently? Well, I read an article that pointed out that I think in this most recent year, better than 95% of corporate earnings are being spent on share buybacks and dividends. 95%. There's nothing left over, really, for capital investment. In fact, I read in an article that I think the average age of our plant and equipment was something like 22 or 24 years. I forget the exact number. But I remember that the article pointed out that that was the oldest our plant and equipment had been in better than 60 years. And so this has been another temporary prop for the stock market. See, not only is the stock market propped up by low interest rates, not only is the Fed propping it up, but the fact that companies are underinvesting in capital equipment and they're sacrificing the future growth and profitability in order to have a higher stock price today. Because what's going to happen in the future, because we've fallen so far behind, because we've invested so little in plant and equipment, that companies are going to have to invest a lot more to make up for it. So that means they're going to have to stop the buybacks and cut back on their dividends, because the shareholders have already been rewarded today. We've brought forward all those rewards. And so this is another artificial prop, because we're going to have to pay for it, right? The good times are going to be followed by the lean years. So not only are stock market investors going to be looking forward to higher interest rates, which will reduce the value of stocks and reduce corporate earnings because of the increase in interest expense, but now corporations are going to have to make up for years and years of underinvestment in plant and equipment, and they're going to have to devote a much larger share of their diminishing earnings in reinvesting in plant and equipment, and so they're not going to have money for dividends, and they're certainly not going to have money for share buybacks. And of course, the other problem with all these share buybacks is think about the prices that these companies are paying to buy back shares in today's market. The market is expensive. It's been propped up by other share buybacks and by the Fed. So the Fed is buying, the companies are buying back shares at a high price. What happens when the economy turns down and interest rates go up, and now these corporations want to repay some of this debt because now it's more expensive to service it because rates have gone up, and maybe they don't have the growth and they need the money. Maybe they need the money to invest in plant and equipment. And how are they going to get the money? If they don't have it, they have to sell stock. So now you're going to have all these corporations who used to be buying stock. Now they're going to sell it because they need money to repay the debt and to make the investments that they haven't been making in modernizing their plant and equipment. So what does that mean? They end up selling stock at low prices because by the time corporations need money, right? Interest rates are up, their earnings are down, they have to make some investments, the share price is going to be down. So what do they end up doing? They're destroying shareholder value. They're buying stocks when stock prices are high, and then they're turning around and selling stock into the market, right, to make investments and repay the debt that they accumulated when stock prices were high. And they're going to sell stock either, just directly selling treasury stock, or maybe they're going to have to do rights offerings, or more likely a secondary offering where they come to the market with new shares, right? New shares sold directly from the company to the public. But maybe, let's say a company, the stock price is at 50 and they're buying stock and it goes to 60 and it goes to 70 and they keep buying stock. And then there's a big recession, the market collapses, rates go up, and now the stock is down at 30 or 20, and now they got to sell stock. They got to sell something at 20, they paid 50 or 60 for it. They're destroying earnings. That means they have even less money to invest in plant and equipment. Meanwhile, what is the consequence on these companies of their failure to make these investments? Money that should be invested in modernizing the plant and equipment is instead being used to buy back stock to enrich the executives who are cashing out. The companies are not going to be globally competitive. Other companies abroad who have been making these investments are going to be more efficient and able to outcompete these U.S. companies. Also, it helps explain why we're not getting the job creation. One of the key factors in job creation is capital investment. Workers need capital. That's what makes them productive and allows them to collect, a high salary, a decent wage. But if companies are not investing in plant and equipment, they're just buying back stock, that doesn't create any jobs. That doesn't create any real wealth. And that's one of the reasons why we're not getting real jobs as a result of the rising stock market, because it's not going up because of the success of these capital investments and the extra production and profits that flow from wisely investing your retained earnings. It's simply going up because of all these share buybacks, and none of that flows through into the real economy, and it doesn't have any ancillary benefits on employment. That's why you're getting this dichotomy between a few very rich people who benefit from share buybacks, but you're not getting the benefit in the broader economy. You're not getting the jobs. You're getting low-paying part-time jobs in the service sector instead of the productive jobs that would normally be the result of corporate earnings. Right, so the whole thing on several different fronts is one big illusion. See, another thing companies are doing to pad their earnings per share while they're buying back stock is they're laying off workers. That's another way that earnings per share have been growing, is because companies are cutting back on their workforce. But, you can only do that for so long. I mean, eventually, you need workers to grow your business. But in the short run, it's firing workers and buying back stock and the cheap money that has been sustaining the bull market. But again, if companies are laying off workers, not only are they not hiring them because they're not making the investment in plant and equipment, but they're firing a lot of the workers they have. And in many cases, they're switching over to part-time, or they're finding ways to cut back on their payroll. Look, I read this week too, Walmart was not only raising their prices significantly, what they're charging their workers. I think it was maybe a 15% or something increase in the insurance that they're charging their workers. And of course, government's complaining there's no inflation, yet, if you work at Walmart, you're certainly seeing a lot of inflation in your healthcare costs, unless, of course, you are a part-time worker at Walmart, in which case you've just lost your healthcare. One of the other announcements that Walmart made this week is that they are going to be canceling their healthcare payments to their part-time workers. And the reason they're doing it is because of Obamacare, right? Because Obamacare says that if you're going to provide your part-time workers with health care, it has to be of a certain quality and a certain standard. Of course, it's more expensive than the type of health care that Walmart was providing their part-time workers. So the government basically says, well, you've got to provide a really expensive insurance to your part-time workers or provide none at all. And given that choice, Walmart decides to supply none at all. So here's a situation where because of Obamacare, people that have health care have now lost it. And of course, now they have to go and buy it on their own, or more likely they're not going to buy it. They'll just wait till they get sick. And then they'll get it off of the government exchange or however Obamacare works. But we're seeing this in corporate America, right? They are cutting back on their workers. They're cutting back on their capital investment, and they're taking the money they save and they're using it to buy back their stock. Sure, the stock market is going up, but what is going to happen in the long run? Obviously, the market has to come down, right? Because we basically sacrificed future growth in the company in order to get a higher short-term stock price. And of course, people look at these stock prices going up and they think that this must mean we have a growing economy. This must mean the Fed's quantitative easing has worked. Hasn't worked at all. Part of the problem is that the stock prices are going up to artificial levels, distorting the economy. Companies are rewarded for these ridiculous share buybacks. And now you have, of course, in the news this week, Carl Icahn, wants Apple Computer to spend a bunch of money buying back stock. Now, he claims it's because, he has no intention of selling. He just thinks that Apple should be buying back stock because he thinks the price will go up because he thinks it's undervalued. But the key is, if the company's undervalued, the stock's going to go up anyway. And the fact that Apple has all this money, if they can't figure out how to invest it in growing their business, then what does that say? Right? Because your business model can't just be generate profits and buy back your stock. And I don't believe that he has no intention of selling any shares. I think the main reason that you want to get the stock price up is because you want to sell. Because look, Carl Icahn's a wealthy guy. If he really thought that the price of Apple should double, he would just be buying more himself. Why would he want to force Apple to do it? Even though he would benefit as a shareholder, he would benefit more if he just bought more stock. He doesn't have to convince Apple to buy the stock, just buy it himself. When you really try to get a company to goose the stock price with buybacks, it's because you already bought all the stock that you want to own and you want the price to go up so you can sell it. But it doesn't help the company to spend money just buying back stock. But it certainly helps the short-term price. But of course, the markets have already started to decline. This was a very, very rough week for the markets. And if this is the beginning of a bear market, then you're going to have that situation where corporations bought back a lot of stock, and the stock that they bought is going to be worth a lot less in the market than what they paid for. Right? So a lot of these share backs are going to come back and bite, and they're going to bite harder the lower the market goes. Of course, again, I do expect the decline in the market to end, but that's only because the Fed is going to get back in the game.
The Peter Schiff Show.
Today's financial advisors behave like pro wrestling TV commentators. They scream that the recovery is strong, debt is manageable, inflation is low, and that the Federal Reserve has everything under control. They may be oblivious, but the danger is real. Looking beyond the media hype can open a world of broader investing ideas. Euro Pacific Capital is a registered investment advisor that offers stock-focused wealth management services that closely follow the strategy of our founder and CEO, Peter Schiff. We concentrate on those countries that are more closely in tune with Peter's vision of how capitalism is supposed to work. And these investments are not hard to find, provided you know where to look. Isn't it time you change the channel and let Euro Pacific put a little reality back into your portfolio? If you live in the United States and have $25,000 or more to invest, call 800-727-7922. That's 800-727-7922. Non-U.S. residents access similar strategies through Euro Pacific Bank at europacbank.com. Euro Pacific Capital and Euro Pacific Bank are affiliated companies.
Get on out of here, 'cause I've been in the right place. But it must
The Peter Schiff Show.
And I done said the right thing, but I must use the wrong line. I took the right road.
So I was reading that the geniuses in Los Angeles, the mayor of Los Angeles, is now trying to adopt a $13.25 an hour minimum wage for the entire city. Right? They just got finished mandating a high minimum wage for hotel workers, but that's not enough. Now they want to force the $13.25 and make it apply to all workers in Los Angeles. And the labor unions don't think that $13.25 is enough, right? They want $15 per hour minimum wage for the city, which would be already higher than the one that they imposed on the hotel industry. But this is being seriously considered. And, I would like to see it pass. I really would. I really want to see a city as large as Los Angeles do something this stupid. Remember that I wanted Congress to, call the president's bluff on minimum wage and just propose a hike of $15 an hour, not phased in over time, but immediately. Let's not wait 4 or 5 years, but immediately, starting right away, make the minimum wage $15 an hour. I wanted him to do that for 2 reasons. One, because I didn't think the president would bite on it. I think they would turn it down. And then that would diffuse the issue. Because it's like, wait a minute, why are you voting this big minimum wage increase down? Right? They would have to explain, it's going to create all kinds of unemployment. Really? Why? Right? Turn the Democrats into the bad guys. So that was one scenario, right? The Republicans proposed $15 an hour right away, and the Democrats refuse. And now the issue's off the table because now they're the bad guys. Or they're dumb enough to pass it. And if they were dumb enough to pass it, the unemployment would be so enormous and so swift that, they would have to repeal it. But of course, the Republicans then could refuse to repeal it in just a lower. And they could say, look, we're not going to lower it from 15 back down to, some lower number. It's either staying at 15 or we're going to repeal it altogether. It's either 15 or 0. And under that scenario, they might have had to eliminate it altogether. But that didn't happen. But if a city like L.A., if L.A. were to impose a $15 an hour minimum wage on the city, the devastation would be enormous, especially if it happened right away. It would be, it wouldn't be as dramatic if they phased it in over 4 or 5 years, but it would still have a big effect. The problem is it wouldn't be as immediate. But if they can get a more immediate big jump in the minimum wage, I think it would be very effective because it would be a not a litmus test, but it would be kind of an experiment that people can look at, right? You can see, not that we needed an experiment. We have already seen the effects of big increases in the minimum wage in other countries. And we've seen it in our own country, when you look at the example of Puerto Rico and you look at American Samoa. But if people need another example, LA would be a great one. And so in that respect, even though I know it's a bad idea, sometimes imposing a bad idea is a good idea because it shows people just how bad the idea was. Because the concept, in theory, let's have $15 an hour minimum wage, right? And everybody thinks it's great. And the people who are working for $7 an hour, they think, oh, God, I could get $15 an hour if those greedy Republicans would just, raise the minimum wage. But all they care about is the businessman. They don't care about the working man. Well, raise it to $15 an hour and let's see what happens. Let's see what they're saying when they're unemployed at $15 an hour instead of employed at some lower rate of pay. And again, I keep hearing people arguing, about this from the point of view of small business. Oh, this is going to be bad for small business. You fall into the Democrats' trap the minute you mention how bad it is for small business. I don't think that people arguing against the minimum wage hike should ever mention business. Stay with labor. Stay with workers. Why do you oppose an increase in minimum wage? Because it's going to hurt workers. It's bad for workers. Because the law, think about it from the workers' perspective. It makes it illegal for you to sell your labor at below a particular price. You know, it's like, what if the government passed a law and said if you own a business, it's illegal to have a sale. You can never reduce the price of your merchandise. That would be bad for business. I mean, businesses make strategic decisions to have a sale. Sometimes they say, look, if I lower my prices, I'm going to sell more merchandise. And if the government said that's illegal, you can't lower your prices, well, that would be bad for business. Well, the minimum wage law is really targeted at workers. It says that if you're a worker, if they want to raise the minimum wage to $15 an hour, it says that you cannot sell your labor for less than $15 an hour. So if you have plenty of demand at $12 an hour, if there are a lot of people who would hire you at $12 an hour, you cannot take those jobs. You have to say, well, no, you got to pay me $15 an hour or nothing. And even if they say, well, in that case, it's going to be nothing, you're stuck with nothing. So it is a law that targets labor. It diminishes the ability of workers to sell their labor at the highest price they can get. If the highest price that you can get for your labor is $12 an hour, and the government says, nope, you can't sell your labor for $12 an hour, you have to sell it for $15. If you can't find a buyer at $15, you don't have a job. So it always needs to be discussed and criticized as an attack on the rights of workers. And it's always got to be, it's going to take away jobs, it's going to take away job opportunities, it's going to take away training opportunities. But here's where it really gets, ridiculous, or where it goes from the sublime to the ridiculous on these labor laws. I'm reading this article, and this is also out in California. And Northern California, and I guess this is the state government. A guy up there in Northern California has a winery, vineyard. And this is not, he's not Ernest and Julio or anybody. I mean, this is a guy, running a small vineyard where his annual operating profits are $11,000. So it's more of a hobby than a business. But, in order to, deduct your costs, you got to make a profit, right? Because otherwise he couldn't even, deduct any of his expenses. So, if the IRS says it's a hobby, it's, not a business, you can't deduct a lot of your costs. So, the guy, though, that's running the vineyard, he's, it's more of a passion for him. It's something that he likes to do. He doesn't need the $11,000 a year. In fact, the time that he spends operating his vineyard, I mean, he's probably not even making minimum wage. So he's not doing it for the money. He's doing it for the joy of doing it. The fact that he, loves making wine, and this is what he wants to do. And so he's operating a small vineyard, and he does manage to make a profit. And I'm sure the profit is part of the fun, knowing that you made this wine from scratch and that people are actually buying it, and you have sales, you have customers. I'm sure it brings a lot of enjoyment to the owner. Now, in order to make it profitable, he has people who volunteer to help out. They help out in the process. And most of the volunteers are retired people. They don't need the income. They're retired, and they're just doing this instead of playing golf. This is what they enjoy. In fact, I'm reading the article. Some of the people who were volunteering said that they got so much fun out of it that they should be paying to do the work, right? Because it's enjoyment. There's one guy that was flying. I think he lived in Southern California. He, at his own expense, flew up there so he can volunteer. That's how much he liked working at this vineyard. And there were some other people there that maybe were younger people that just wanted to learn the business. They wanted to make wine. They wanted to learn how to make wine. So by working at this vineyard for nothing, helping out, they were gaining a lot of knowledge. They were gaining an understanding. They were getting work experience so that if they wanted to start their own vineyard, make wine, they knew how to do it. It was like a school of winemaking where you didn't have to pay any tuition. So you can graduate without having to take any debt. So it's a win for everybody, right? The guy that's running it, He's making wine. People are buying it, right? So the customers win. He wins. He enjoys. He's got people who are volunteering their time. Nobody is putting a gun to anybody's head. So the people who are volunteering, they're enjoying it, right? People are learning a trade. Maybe some of the people who are learning will open up their own vineyard. Maybe they'll be bigger. Maybe they'll actually employ people and write them paychecks. Well, anyway, the government came in and said, this is terrible. You can't do this. You can't have people working for free. And the owner of the vineyard was slapped with a $115,000 or several fines that in total accumulated up to $115,000 in fines. Now, the guy's only making $11,000 a year in profit. So what is that? That's 10 years of profits in fines because he's not paying workers who don't want to be paid, who are volunteered. And of course, if he had to pay these workers, he probably would have shut the vineyard down, which is what he's doing now anyway. So now, because of the government, the guy can't make wine. So now he doesn't get to pursue his passion, or if he makes it, he just can't sell it. He can make wine, he just can't sell any of it. And so if he can't sell it, he can't recoup his costs, so he's just not going to do it anymore. So who loses? The customers lose because they can no longer buy the wine. I guess if they were buying it, they must have enjoyed it. I mean, they could have bought other wine, but they chose to buy this wine. So they won't have that choice anymore. And all the retired people who were enjoying this experience, they can no longer participate in something that they loved. Obviously, if they didn't love it, they wouldn't do it because they weren't getting paid. So they must have enjoyed it, right? But nope, this kind of enjoyment is not allowed by the California government. And what about the people who were trying to learn, who wanted to be maybe run their own vineyards one day and were hoping to learn with the opportunity to work at this vineyard? Well, they no longer have that opportunity. So now what are they going to do? Go to some school and learn from somebody who probably doesn't even know as much as this guy that was running the vineyard? Or, so everybody loses. Now, what is this? Of course, the origin of this law probably is not to protect these workers because there's no workers who are being exploited, right? Most of these guys are retired, right? This is what they're doing this instead of playing pinochle or bocce or golf. This is how they get their fun, right? But the real reason for this, obviously, is they're trying to protect other vineyards who are forced to pay the wages because they're operating on a bigger scale and they're trying to make sure that everybody has the same overhead. But why anybody should worry about a guy so small that his total annual profits are $11,000? Like this is a big threat to the California wine industry? How big is the California wine industry? But again, it shows the hypocrisy of these kind of laws when the supposed purpose is to protect workers. These workers don't need protection, right? They had an entertaining thing to do. They didn't even look at it as a job. It was an opportunity to enjoy doing something, learning something, accomplishing something, getting together with friends. I'm sure that these guys drank a lot of that wine that they produced. And they probably had a good time. But the government is calling an end to that party. But this is the kind of stuff, this happens on much bigger scales. Because imagine if these workers were being paid something, but they weren't being paid enough. They'd now be unemployed. I mean, they don't have to worry about the fact that they're unemployed because they didn't need the money. They just enjoyed the experience. Now they got to figure out something else to do with their time. And maybe they'll have to pay. Maybe they'll have to pay to do something else. Maybe if they play golf, they're going to have to pay the green fees or they're going to have to pay for the cart, right? This they were getting for free. They had this enjoyment and it didn't cost them anything. So now they're going to have to pay for their leisure activity. But this just shows, so the government comes in and now the enterprise is gone. This stuff happens all the time on a bigger scale. What's going to happen in California if they actually pass, or in Los Angeles, if they mandated $15 an hour? A lot of businesses are just going to shut down. That's all. It's like a fine for hiring people. I mean, if you have to hire somebody and their productivity is $8 an hour, and the government said, well, you got to pay him $15 an hour, you got to pay a fine. It's like if you hire this guy for $8 an hour, you have to pay a $7 an hour fine for every hour he works. Why would you want to do that? In fact, the fines could end up totally more than you make. And so, you'll try to automate, you'll try to outsource, you'll try to, cut back on labor any way you can. But if you just can't eliminate enough labor and stay profitable, you're just going to go out of business. And again, I would like to see, not that I, wish harm on anybody, and I would certainly feel badly for anybody in Los Angeles who got fired because those idiots raised the minimum wage. But maybe their sacrifice won't be in vain if it shocks other legislatures into reality. I mean, something has to be done to change the political, winds. Because right now, minimum wage increases are popular. In fact, I think this election coming up in November, I think there's like 4 Republican states. These are red states that have measures on the ballot to increase the minimum wage that are expected to pass. You even have Republicans dumb enough to believe that we need to raise the minimum wage. So something has to be done to shock people into an understanding of how dangerous and how economically destructive this type of law is. And it's most painful and most destructive on the people who the law is trying to help. Because the law is trying to help low-income workers, unskilled workers. Those are the very people who suffer the most as a result of the minimum wage. If you operate a business to the extent that your competitors are all forced to live with the same minimum wage as you can figure out how to survive because everybody's got this problem to overcome. Everybody's got to raise their prices. Everybody's got to substitute machines for people, right? Everybody, the playing field is leveled. So in many cases, the businessman can figure out how to operate with a higher minimum wage. He might not operate as efficiently as he did before, but his competitors are in the same boat. So he can stay in business if, and maybe he'll earn less money, but he'll employ a lot less people. So the biggest losers are the workers who lose their jobs and those workers who never get jobs, never get training, never acquire skills, never climb up the corporate ladder.
The Peter Schiff Show.
I'd like to welcome to the Peter Schiff podcast, Peter Thiel. And Peter is going to be the first guest that we've had. I used to have guests on every day when I did the radio show. Now that we're doing the podcast, so far, this I think is the 5th podcast. And Peter is the first guest. And I'm delighted to have him. Really doesn't need much of an introduction. He was the co-founder of PayPal, was one of the earliest investors in Facebook. I forget who played you in the movie The Social Network, but a great story. He is probably the most successful entrepreneur investor who's also a libertarian that I know of today. He's donated to a lot of really, really good candidates over the years, and he's got a new book out, and I want to start off talking about your book, 0 to 1, Notes on Startups and How to Build a Future. And there's probably nobody better qualified to write that book than you, Peter. So tell me a little bit about it.
Well, Peter, thanks for having me on your show, your program. The book 0 to 1 came out of a class I taught at Stanford, where my goal was to convey everything I knew about starting technology businesses and a business in general. And then we sort of one of the students in the class, Blake Masters, took notes. They posted them on the internet. We got over 1 million page views on the notes, and we've decided to distill it into sort of a 200-page book that tells everything we've that I've learned about business over the years. There are sort of many different themes. I'm very focused on sort of these contrarian kinds of questions, like what great business is nobody building, or intellectually, what is true that nobody agrees with you on? It's never that interesting what's true that everybody agrees with you on. That's already priced in. That's merely conventional. I think great businesses, great insights always come from discovering things that people don't yet understand or don't yet appreciate. And that's so the next, Mark Zuckerberg will not be building a social networking company. The next Bill Gates will not be building an operating system. And if you're copying these people, in some sense, you're not learning from them. There are sort of many different answers I give to this question: things that I believe to be true that other people do not. But perhaps the core answer is that I believe that capitalism and competition are antonyms, not synonyms. We always believe they're synonyms. I believe they are antonyms. I believe that a capitalist is someone who's in the business of accumulating capital, and that in a world of perfect competition, the profits are competed away. And so the goal, if you're an entrepreneur or a founder of a company, is to do something that's so unique that you have a monopoly. Monopoly is the goal of every.
And you know, a lot of people think that monopoly is a bad word, and I think that to the extent that a monopolist derives his monopoly position from some special protection provided by government, where government can make it illegal to compete and they get a license, then I think that it's bad. But I think that if a monopolist can achieve that status because he delivers a product or a service that is so good that nobody else can match it, that his customers are so satisfied that they don't need anybody else, then I don't see how it's a threat. But just maybe a slight clarification or disagreement. I don't think that that capitalism and competition are necessarily antonyms or synonyms. I think that competition is a part of capitalism, and capitalism as differentiated from socialism, where capital is allocated based on market forces, not based on government decree. But just because a company may enjoy a monopoly position doesn't mean that competition isn't a factor, because I think the monopolist in a free market knows that there is always the threat of competition. And in order to keep those potential competitors at bay, you have to constantly innovate. You have to constantly be providing your customers with a better experience, with a higher quality, with a lower price, to make sure that you don't leave a window of opportunity for somebody to come in and to compete away your profits.
Yeah, all of that is true. The place where the place I would emphasize, though, is that I think this question of monopoly or competition tends to be very much obscured. You know, almost every business book you read is about how to compete more effectively. It basically tells the readers what you need to do is you need to become better at competition. When the Wall Street Journal ran an excerpt from my book, the chapter titled excerpt, the title they came up with was "Competition is for Losers," and this was sort of obviously we normally think of losers as people who are bad at competing, but if you're too attracted to competition, if you go into things where the competition is ferociously intense, you will lose even if you win. It's it's like you can open a restaurant if you love competition, or you can try to become an academic. There's the Henry Kissinger line about his fellow faculty members at Harvard, where the battles are so ferocious because the stakes are so small, which on one level sounds like a definition of insanity. You know, why would you have ferocious battles when the stakes are so small? But it also follows from the logic of super intense competition, where it's almost impossible to really differentiate yourself from the other people, and so the competition becomes more ferocious in a way as the stakes are quite small. So I agree that I also agree with you that you don't want to have state-protected monopolies. You know, those become tax collectors, toll collectors, like the post office, or all these sorts of institutions are probably quite bad. And there's always a dynamic possibility that monopolies get superseded, especially in technology, to the extent we have technological innovation happening.
Yeah, and I'd like to talk a little bit more about some of the companies, the startups, particularly as it relates to market caps or IPOs. A lot of my listeners are interested. I know you're invested in many startups. I mean, one of the I think probably the most popular ones that is yet to be public is Uber, which I know that you're involved in. But when you talk about competition, I think that nowhere is competition as fierce is with a lot of these online companies. And I think that some of these companies in their early stages, when they're very successful because they basically give away their products, or they price them so low, and they're really not concerned about making a profit. They're concerned about just generating a user base so that they can, say that they have all these users and all this growth potential because they've come up with all these people that use the service, and that one day they'll figure out how to monetize it, but they just haven't figured it out yet. And then somehow the market is able to assign these enormous valuations to these companies based on the theoretical potential that one day they'll be able to make a big profit, even though they haven't made any profit yet. And it would, I don't know if you agree with me, but I think that it seems that there's really no way for most of these companies to ever make a big profit, because if they ever did, I think the barriers to entry are so small when it comes to online that they would quickly lose them. And I think it's a pipe dream. When
Peter, obviously I disagree with that, since I spend my life investing in these companies, and if I really believed that, I would pack up right now and stop being a venture capitalist.
Well, some of them. This is not all companies, right? Some companies can generate a profit, but there are some that just haven't in years. And it seems like, how would they be able to maintain big profits when there's so much potential competition out there?
It's because I think the answer is because there really, beyond a certain point, there really is not. If you take a company like Twitter, it has a market cap of $32 billion right now. I don't believe it's actually had a quarterly profit yet, but it has a certain amount of growth, and it is absolutely impossible for anyone to come up with a comparable service. It's growing. It has network effects, and then there are a lot of debates about what its profits in the future will look like. Google, has had no competition, meaningful competition, since 2002 in the search business.
But Google makes a lot of money. I mean, Google is not Twitter. I mean, Google has actually found a way to monetize its business, and it's pretty profitable. And the multiple.
Certainly, the venture capitalists, back in 2001, 2002, people were worried it would never make any money. And there was even a crazy episode where some of the investors wanted their money back in, I believe, 2002. And so there's always a sense, PayPal, which I started, we were, losing enormous amounts of money, and it probably would be a $30-40 billion business as a standalone business right now. We did a discounted cash flow analysis on PayPal in March of 2001, and we concluded that under sort of reasonable assumptions, we'd been in business for only 27 months at that time. Under reasonable assumptions, 3/4 of the cash flows on a discounted basis would come in years 2011 and beyond. So these companies are, because they're not making money now, I think what their high valuations reflect the ways in which they're based on cash flows that are coming very far in the future. Now, some companies, these cash flows may not happen, but I'm not sure that they're systematically overvalued or misvalued.
Well, I'm sure, like at the stage that you get involved, right? When you get involved in a company, it's really early on, right? You're getting involved in the beginning stages, the VC stages. Where although now even some of these valuations now, where I see these rounds of financings of companies are still taking place, these later rounds at very, very, to me, what looks like very, very high prices. But ultimately, by the time the average guy who might be listening to my podcast, by the time he gets a chance to buy, it seems like all the easy money is made, and they're just taking a flyer, and they don't even get the IPO, because the IPO goes to the mutual fund or the hedge fund. By the time the guy can buy it, it's already popped on the IPO, and now he's got to buy he's got to take out the guy who bought the IPO.
Well, certainly one of the things that's very different from the 1990s, and one of the reasons I do not think we have a bubble in tech stocks today, is that the public is not involved, the IPOs are happening incredibly late. There's a Sarbanes-Oxley reason. There's a bit of there's been a shift within Silicon Valley where there's less pressure to have early IPOs. There's less of a need to sort of be on a crazy quarterly earnings cycle too early. And so yes, I do think that there's a lot of potential in this area, but it's one that's very hard for people to invest in because the IPOs are extremely late.
Yeah, one of the reasons I think that the public is kind of absent and not involved the way it was in the dot-com bubble is for the same reason they're not involved in the current housing bubble. I still believe we have another bubble in housing, even though the individuals are not participating. It's the hedge funds that have been buying up all these single-family homes and hoping to rent them out or flip them. It's that the average American is too broke to buy stocks and too broke to buy a house. And so all the speculation is being concentrated among very wealthy people that have been able to benefit from the quantitative easing and the 0% interest rates that has inflated these bubbles, but they've left behind a lot of people who can no longer afford to play the game. And so I think that it doesn't mean that just because the average investor isn't gambling, I don't think it means it's not a bubble, because I think a lot of sophisticated people can still make the mistake of getting caught up in the frenzy of a bubble and end up overpaying for assets.
Well, I share a lot of your concerns about these weird bubbles that we've been going through as a society. Starting with the crazy hyper bubble in the Nikkei in the 80s, the internet bubble in the 90s, the housing finance bubble in the last decade, and it would be surprising if there was not another bubble going on today. I tend to, it's probably somehow linked with fiat money and the complete breaking of the gold standard in 71. I also agree with your intuition on that. My guess is if you held a gun to my head and said, where is the bubble centered today? I would say it's centered on government bonds, on quantitative easing, on negative real interest rates. And then what's very pernicious about this bubble, which is probably even bigger, is that the negative real interest rates touch every asset class. But I would say the caveat I would give is that they touch certain assets more than others.
Well, here's the thing, though, Peter.
Some assets that are more like bonds than others. So the assets you want to be really careful of are assets that trade like fixed income. So corporate bonds, housing, which is linked to real interest rates. You want to be super careful of housing. You want to be careful of stocks that have high dividends or that are like value stocks, because those are modeled kind of like bonds.
But I think, Peter, they don't pay dividends, but they're very high multiple stocks. And I think high multiple stocks are also vulnerable to a big increase in interest rates, because you're trying to discount cash flows that are way, way out in the future. And the further out in the future the cash flows are, I think the more sensitive they are to the current rate of interest. And I agree with you that there is a bubble in the bond market, and all the bubbles that we've experienced have had their roots in cheap money and interest rates being too low. And they've never been as low as they are now for as long as they've been. We've never had so much money printing. So for there not to be a bubble, given all of the air that the Fed has been blowing, would be unprecedented. And if the biggest bubble is in the bond market, and I'm not going to argue, I mean, that's a huge bubble. But when that bubble bursts, you have to understand that there are other markets that rest on the foundation of that bond bubble. Because when the bond bubble bursts in sovereign debt and interest rates go up, that means mortgage rates go up. That means housing prices crash. And when when interest rates go up, that brings down the stock market, because by definition, stocks are a function of the discounted value of their future cash flows. And the higher the interest rate, the less those flows are worth. But I also think what's been driving corporate earnings has been share buybacks. And I think corporations are levered up, and they need those low interest rates to keep their income going. And when interest rates go up and their debt service cost goes up and their revenues go down because their customers are spending more on interest, the whole thing can implode. So if you think there's a bubble in bonds, if that bubble bursts, everything goes like a big house of cards.
I would respectfully, I would disagree in the sense that I think there are some things that are impacted much more than others. And so,
I
in
agree
the
with
last decade, the key asset to stay away from was housing, because that was the center of the bubble. Tech stocks did correct a lot in 08, 09, but came back within 6 months because the bubble was not centered on tech stocks in the last decade. And so I think when this one ends, the place where you really will lose is in things that are like fixed income. It's possible that it impacts these growth stocks because so much of it's very far in the future. But I think the biggest variable in analyzing the growth stocks is actually just, is the growth going to happen? And it's perhaps not so much the specifics of the discount rate, but it's the specifics of, is the growth really going to happen or not? And that's a somewhat different variable.
And in many cases, the fact that it's happening is already priced in. So it has to happen just to justify the current price. I mean, even if you get the growth, but it's not as robust as people anticipate, the stock prices can still lose a lot of ground. But the main reason that the stock market came back.
Peter, let me put it this way. If you think about a stock, you have a discounted cash flow analysis of stock. Part of it's the growth variable, part of it's the equity premium, part of it's the risk-free rate. In the 90s, the tech bubble, the central lie was that the growth was phenomenal and the growth didn't happen. That was the lie in the 90s. The lie in the 2000s was on the equity risk premium. That was the lie in the 2000s, that you could have super tight spreads, you could have all these complex products, and there was going to be no volatility. The lie in the 90s was called the new economy. The lie in the 2000s was called the great moderation, permanently low volatility, super low risk.
So what's the lie now, in your opinion?
Well, the lie now is risk-free rates, and the lie is called secular stagnation. And that secular stagnation is actually, now it's less bullish. That sounds less bullish than the great moderation, which was less bullish than the new economy. So we've had these bigger and bigger bubbles that are described in sort of less ebullient ways. But you have to understand that even when Larry Summers talks about secular stagnation, he's actually trying to make an argument for pumping up asset prices, because the secular stagnation means that the Fed can keep and safely keep rates at zero forever. And so secular stagnation is actually a hyper-bullish sort of argument that people are making today.
But I would argue, though, that if you believe there's a sovereign debt bubble or a government bond bubble, that bubble bursting is going to have a much more pronounced impact on the economy and on assets than either a stock market bubble or a real estate bubble. It is a much bigger bubble. It is much more important. And you know what was able to drive stocks back up after the housing crisis was because the government was able to inflate the bond bubble. It was the driving down of interest rates and the printing of money that lifted up all those stock market boats. But if we have a sovereign debt crisis where bonds crash and interest rates shoot up, that is not an environment where stocks can rise. I mean, only if the government just tries to reflate the bond market bubble and creates hyperinflation. And if they do that, if they take the value of the dollar, because I think the dollar bubble is tied in with the bond market bubble, and if the government tries to keep the air in the bond bubble because it doesn't want bond prices to crash and interest rates to skyrocket, because that would bankrupt the federal government and the big banks and cause a worse financial crisis than 2008. So if to avoid that, they just keep printing money and they blow up the dollar, then sure, stock market won't go down, but it's not going to matter to a lot of people, because in terms of gold, it will crash. And in terms of other consumer goods or commodities.
I don't have a strong view on what happens with commodity prices from here, certainly I think the gold prices are highly linked to the risk-free rates, and so if gold will do fine if the risk-free rates stay low. I don't know if they can stay this low indefinitely, and that's probably the big vulnerability to gold is there some point at which people stop believing in QE and sort of throw in the towel, which they seem to actually be doing at starting.
They are doing that now. I think that's why the dollar's risen. That's why gold has come down. But I don't believe that the Fed is throwing in the towel on QE. I think they're all in on QE. I think that another round of QE is coming. I think the people who are expecting rate hikes are wrong. The next thing the Fed's going to do is unveil a bigger QE than the one they just tapered off. Because the economy is in worse shape now than it was when they began QE, and just like they couldn't end QE1 or QE2, they can't end QE3. We are in this forever. Once you go down this route, you can never turn back unless you're prepared to go cold turkey and have a huge recession, which obviously they're not prepared to do. The Fed is going to fight a recession. They're not going to embrace it as the cure for the problems they helped create. They're going to fight every inflation with more of the policy that caused the problem that the recession is trying to solve. So I'm 100% convinced that we're going to have a bigger round of QE because the economy is headed back into recession. And so I think that's bullish for gold. I would agree that if we ever had real high interest rates, that could be a bearish scenario for gold, but that would be bearish for everything. I mean, if the Fed were actually to raise interest rates, you'd see all asset prices go down. And in fact, gold might come down less than real estate and stocks and bonds in a scenario where the Fed was aggressively raising rates.
Well, I think I would say one place where we may disagree a little bit is, I'm sympathetic to a lot of your critiques of the Fed policy. I think that in some ways the bigger problems are actually all the micro-regulatory kinds of things. And so, one of the things that's remarkable is that the Fed's been able to get away with this for as long as it has, and it's remarkable how the real interest rates. It's remarkable how the real interest rates have it's been able to stay so low for so long. In 2009, 2010, a lot of conservative or libertarian people are saying, all this government borrowing is going to lead to create a shortage of capital in the private sector, and even with trillion-dollar deficits, there was no capital shortage because I think the economy is so regulated that people can't invest the money.
Yeah. Although I think there are shortages. I mean, certain types of businesses can get capital, but your mom and pop, the Main Street type businesses, they can't get capital. I mean, and that's one of the reasons why we're not creating the small businesses. Entrepreneurship is down, the labor force is shrinking, and it is all because of government. I mean, government has created so many barriers to job creation and employment, business formation, business growth, all the regulations and taxes that are strangling companies, not only in America, but all around the world. And it's so unfortunate because you have real serious problems around the world that government has created. But instead of addressing the cause of the problems, they all want to blame it on inflation not being high enough. And they want to have the central banks try to solve problems that bad laws, bad regulations, and subsidies and taxes have created. And all they're doing is forcing the ECB or the Bank of Japan or the Fed to try to fight these problems by creating money, by creating inflation, as if that is the problem when, it's not. In fact, falling prices are a positive economic factor. They lead to rising living standards. Being able to buy more stuff for less money. That's the goal of capitalism. That's what enriches everybody. It's bringing prices down so that more people can enjoy lower prices that come with abundance. But somehow they've turned that around and they've created this fictitious enemy of deflation, and they've unleashed these central bankers to try to print all this money on the hope that this inflation is going to lead to economic growth and job creation when it's going to actually inhibit all the things that they're promising.
Yeah, I would say that we sort of have. I think if you would describe what's going on now, I would say we have deflation and inflation in sort of all the wrong places. You have inflation still in commodities. You have inflation in all sorts of things like housing, things people need to buy, and rents. You have deflation in wages, deflation all these other ways, so that people's real earning capacity has gone down. So even though the average inflation's been low, if you sort of look at the components, people's wages are flat to going down, and then food and rent is going up fairly steeply. And so it's sort of like the worst combination of bad deflation and bad inflation. So I think you need some new word like retroflation or something like that.
Yeah, but what's really going on, though? The thing is, labor costs are going up, even if wages are not. What's happening is employers are having to spend more money on mandated benefits, on litigation, on complying with all sorts of rules and regulations, so that more of a worker's productivity is diverted to government and lawyers, and therefore there's less left over for the worker. That is the problem, because normally if wage costs were falling, that would be good because that would mean lower prices. And what's important to a worker is not your nominal wage, but your real wage. And, what can you buy with what you earn? But the problem is so much of the productivity is being diverted away from the worker to pay for all these government mandated expenditures, that the wages are falling and the prices are rising. But for some reason, all these price increases fail to show up in the government measures. They pull out the CPI or the core CPI and they say, oh, the prices are only up 1%. We need more inflation. Meanwhile, the biggest problem that most people have in America is the rising cost of living. And the government wants it to rise faster. And they say that's the solution.
Well, look, I think we have I think the regulatory load issue is in my mind the core problem in this country. It's not just labor laws, it's environmental laws, it's it's basically all sorts of things that cannot be done. In the technology sector, I always say that we've had a lot of innovation in computers, internet, mobile internet, in the world of bits. We've had very little in all these other areas: energy, transportation, space travel, underwater cities, all the things people thought about in the 1960s in the world of atoms. And it's because bits have been relatively unregulated, whereas atoms have been heavily regulated. And engineering has been a terrible career choice for people for the last 40 years. Computer science typically wasn't even an engineering major, but if you went into nuclear engineering, aeroastro engineering, mechanical engineering, chemical engineering, these were horrible choices because you were going into this massive headwind of increased regulation where we basically have outlawed technological and scientific progress in this country.
Yeah, I mean, anywhere that you have lots of government involvement, whether it's healthcare, whether it's education, you stifle creativity and entrepreneurship and economic growth, and I think you've talked. I think you actually were involved in that, right? You were paying. I don't know how well that program worked. You were paying some people not to go to college. You were giving them some startup money for businesses if they were to skip college.
We have my foundation has this program for 20 students every year to stop out of school for 2 years and start business. The program's going quite well. It's not the sort of thing that can be scaled too much, and it's, again, you can start businesses in the IT sector because that's the relatively unregulated sector. Most other sectors, it's very hard to do. It may cost you $100,000 to start a software company. It costs $1 billion to get a new drug to market.
Yeah. Unfortunately, for a lot of young people, the biggest mistake they make is going to college. They go to college, they major in some liberal arts. They don't really learn anything of any relevance, but they waste 4, 5, 6 years of their youth where they could be out in the real world learning and acquiring skills that might be valuable in the marketplace. And instead, they waste their time at these universities. And then when they graduate, they're in debt. They owe a lot of money, and that might limit their choices and their opportunities to do things because they have this huge debt burden to service. And meanwhile, the reason that college is so overpriced is because the government is so involved in inflating the costs with subsidized and guaranteed loans. And it's just an example of the failure of government where they've managed to destroy the value and increase the price of a college degree at the same time.
Well, I define technology as doing more with less, and so the things that are the most anti-technological are places where we're doing less for more. That's education. Certainly, education's at the center of this. Real costs have gone up 400% since 1980. So it's more inflation, and there's been no improvement in quality. Healthcare, it's sort of true. I mean, there's been some improvement in quality, but you get the sense that prices have gone up way more than the quality has. And it's true of almost all areas the government's involved in are anti-technological.
And the thing is, we have no idea how many more advances might have been made, both in medicine and in education. I mean, how much more efficient and how much less expensive all of this would be. I think if the government had stayed out of education and healthcare, both of them would be a much smaller percentage of our GDP right now, which is what we want. I mean, you don't want to spend a lot of money on healthcare. You want to be healthy and spend as little money as possible staying that way. The same thing for education. You want to educate yourself with as little resources as possible so that you have more resources available for the things that make us happy, which are the consumer goods. That's what we all want. We all want a better life. We want more leisure. We want more stuff. And the less money that we have to spend on healthcare and education, the more resources we have for all the stuff. And the only reason theoretically education is important is because it helps us make more stuff. Supposedly, if we're educated, we're going to be more productive. And if we're more productive, we have more stuff. But, the problem is that's not what we're focused on. We're just focused on spending money on education and healthcare as if these are ends in and of themselves when they're not. They're a means to an ends, and we forget what the actual ends are.
There's sort of all these ways that there's always a question of what education is, what sort of a financial asset it is. And you can sort of say, is it an investment? Is it a consumption good where college is a 4-year party? Is it a really expensive insurance policy to avoid falling through the cracks in our society? What I think it is for the most part is a zero-sum tournament in which where the value comes from a system of exclusion you get into the top schools, and that has a signaling selection value to people, and then for everybody else, the diploma is a dunce hat in disguise. If you were the president of Harvard or Yale, you would get the one way you could be fired immediately would be if you proposed doubling the enrollment. But what sort of a good is it where you can't double the supply? Like every business would expand. It's like maybe it's like a Studio 54 nightclub or something like that, where the value consists of excluding people, which goes completely against the way it always gets characterized as this completely positive sum thing where it's just knowledge and we're spreading knowledge to more and more people and everyone's benefiting. But if you actually try to increase enrollment, and there's a good argument for doing it. The U.S. has 50% more people today than it had in 1970. There's a global economy, so these schools are attracting people from all over the world. So there's a good argument for dramatically increasing enrollment, and that's absolutely inconceivable because it is a zero-sum game. It's not a positive-sum game.
And especially with the technology that exists today, it makes it that much easier to educate more people because of the computers and the way that education can be delivered.
If it was about learning. But it's not about learning. It's about signaling. It's about status. It's about exclusion.
Mm-hmm. But it seems to me there'd be an opportunity, an entrepreneurial opportunity, just for some type of company that could just kind of, instead of a degree, it's kind of like a competence certification where you can go through an intensive, couple of month program where you can graduate, where you're certified that you have competence in certain areas, where instead of, looking for a college degree, they can say, yes, I went through this program, and it's almost like a pre-screening of a potential job applicant. Yeah, this guy is, he's a good candidate, just do something like that instead of spending all this money.
People are starting to do this in a number of computer programming, coding things where in, 3 to 6 months you can learn enough to get a reasonably well-paying job. And so there is, that's the one place where we start to see this happening. But I think when this education bubble comes to an end, there'll be different ways of doing it. There'll be some cheaper alternatives, but I think there will actually just be less money spent on education, and it will be a smaller industry. Mm-hmm. It is way too big. It doesn't do very much.
Yeah, and some of America's most successful entrepreneurs in history, not only didn't they go to college, they didn't even go to high school, and they made billions in inflation-adjusted dollars. And I think, if you're going to be a self-educated man, if you're going to be self-educated like it's so much easier today with the internet than it was 100, 200 years ago to teach yourself. And, you've got a new book out there. I mean, maybe your book is a lot more valuable to an entrepreneur than sitting in some classroom from somebody who's never been an entrepreneur trying to teach you, some entrepreneur class. You can just, there's so many people out there that you can learn from on the internet. There's so many ways to educate yourself, and that doesn't cost anything. You just need an internet connection, which is pretty much free.
One of the surprising factoids I heard the other day is that of the people who become billionaires by age 40 in the U.S., 75% do not have a college degree.
Yeah, I don't doubt that. Some of them are in college, but they drop out. But the ones that were billionaires in the 19th century, and adjusted for inflation, they were richer than the billionaires today. The Vanderbilts, the Carnegies, the Rockefellers. These guys didn't even go to high school. Some of them didn't even graduate from elementary school. But they worked. They started working when they were age 12, 13, 14, and they just worked their way up. They didn't inherit any money. I mean, their children inherited money, but the original Carnegies and Rockefeller started from nothing. They started from simple means.
There is this very odd academic bias against work, which is where it's sort of like you're either in the ivory tower or you're relegated to the coal mines, and that sort of work is this incredibly dirty, described as this incredibly dirty thing, and learning is this incredibly noble thing. It's just very strangely decoupled.
Yeah, and of course, the main beneficiaries of this.
It's similar to what's happened with money, where we've decoupled money from reality. Fiat money is decoupled from the things it represents, and there's a similar decoupling that's happened in education, where it's like learning is decoupled from work.
Well, that's the problem. Money used to have real value. When money was gold, It represented the real effort and the work involved in mining it, and it had intrinsic properties that gave it value. And so money was real. Now it's nothing. Now the Fed just creates it out of thin air. It has no real value, and they can create an unlimited supply, and they will. That's the problem. They keep on printing it, and that's why we're headed, I think, for a currency crisis, a monetary crisis, when this mother of all bubbles finally bursts. Well, again, hey, Peter, it's really been a pleasure having you on the podcast. Really enjoyed talking to you. Again, your new book, it's 0 to 1, Notes on Startups and How to Build the Future. You can pick it up, Amazon? You could use your PayPal account, right, to pick up a copy?
Yes.
Yeah, I think of you every month when I get my credit card bill, because my wife is using PayPal all the time, and it costs me thousands of dollars every month when I see these PayPal on my Visa bill. But anyway, hey, Peter, look, again, thanks for being on the show. Good luck with the book and in all of your endeavors.
Thanks for having me on the show, Peter.
That's it for today's podcast. I hope you're enjoying it. I hope you are sharing it with your friends. Don't forget to like us on Facebook, to subscribe to our YouTube channel, follow me on Twitter, and help me spread the word about the Peter Schiff Show in podcast format, so we get more people listening on a weekly basis to 2 hours of economic sanity in what is really an insane world.